Good afternoon, ladies and gentlemen. Robert Rayburn here from Life Pro Asset Management. It is April 14th, 2021, and I finally got the year right. I know there's been a few of those weekly updates where I seem to be living back in 2020. But yes, it is 2021. I am joined here by our associate, Tim Devlin. Tim, how are you doing today?
I'm doing well. How about yourself?
I'm doing great. Couldn't be better. And ladies and gentlemen, as we go through the month of April, we're continuing to see that reverse rotation back into the more secular, more durable areas of long-term growth within the stock market. Something that we've really been talking about the last 2 or 3 weeks as we went through that rotation correction in March, which was certainly painful, no doubt about that. But I think that's something that really sets our platform apart from everyone else. And that is when you do get these temporary rotations, we don't go out there and try to chase return. What we do is stay focused on the best of breed companies that are in the process of going from good to great, and then making sure that nothing fundamentally has changed as we go through these corrections. And if anything, we use downturns in the market to go and buy some high quality merchandise that's on sale. And that's what we've done through March. There was a couple names in there. You'll notice that we added, whether it was our Ethereum exposure or padding up that Unity software exposure, or we can go kind of across the board there, and or our CCIV. That was the other one that I was kind of thinking of at the top of my head. But I think when we look at the next 6 to 12 months, we're really excited, and a lot of these companies are sort of clicking on all cylinders. We recently had that Coinbase IPO come out today. That's caused some consternation in the overall market. Pretty normal because it's a $100 billion IPO. What's happened here, ladies and gentlemen, is that you're getting a lot of portfolio managers, hedge funds that have to make room for that. And so they sell stocks to raise money and then go and buy that stock. When it's a $100 billion IPO, that's something that usually causes some volatility. In addition to that, it was what's called a direct listing. So there's no price set. So you get some messiness there. We like that company. We're continuing doing some work on it. Wouldn't surprise me if at some point in the future we have some exposure there. But these direct listings have a history of being messy, which is why we didn't participate on the IPO. And thankfully we didn't, because it was definitely a little bit messy today. So I'm going to go ahead and get started here. I'm going to share my screen with everyone, and just give me one quick second here. All righty. So the real theme, Tim, behind this week's stock market update is what we call the spring counteroffensive. And in March, a lot of the growth leaders that led the stock market, not just in 2020, but kind of going all the way back to like 2014, 2015 through a couple of months ago, got hit. And the theme was, hey, if your company was a stock market leader over the last 12 to 24 months, sell it. Hey, if you had a crappy junk stock company, or you call it sort of a boom bust type of stock, and it underperformed over the last 12 months, well, go buy it. And that's just not the way we operate. We stay focused on quality. And one thing we've been very, very consistent on, ladies and gentlemen, since February, is that inflation is not that big of a deal. We don't see sticky inflation in the pipeline. And the only thing that's driving up inflation is that we're coming up over those year-over-year comparisons where inflation was super, super low last year because of the shutdowns. So it artificially appears high. And when we got the data 2 days ago, there was no real inflation to speak of. There was some temporary surge in inflation as we lapped those year-over-year comparisons, but that's really why you saw a big breakout in many stocks yesterday. And today was more of the IPO issue where you had that temporary sell-off. But the fact that inflation is out of the way now, that data that everyone was terrified about, allows us to really focus on the stuff that matters, which is long-term growth, durability of growth, the leaders, who's leading the economy into the next generation. That's our bread and butter. That's where we focus our time And that's ultimately how you can make money and build wealth in the stock market over a 5 to 10 year time period. Second, Wall Street remains bearish. When the consensus is bearish, that's a good thing, ladies and gentlemen. Remember what we talked about last week? When it comes to investing, we need to shun our human inhibitions of wanting to be with the crowd. And we want to be alone. And we want to let the market skate toward our position. And that's what we're doing right now. The majority of Wall Street strategists are bearish, or their price targets are below the current S&P 500 level. We're going to walk through why that's a good thing. And then last, but certainly not least, the foundation of the market, the credit markets, haven't blinked at all and remain healthy. Very, very important when we talk about the structural health of the overall stock market. Now, real quick here, we've made up a lot of ground. We're down about 1.28% year to date here in 2021. We've made up about 10%. That's where we want to be. Today we had a bit, I think we were down to about 1.9 or so. But a lot of that, again, IPO noise as it relates to Coinbase. So I'm not really too concerned about that. When we look at those 1 year numbers up 115.82%, 65, 66% ahead of the S&P 500. And again, putting us as one of the top performing strategies in the US over the last year, and something we're very proud of. And we go through to inception up 223.42%, outperforming the market by just under 140% after fees. So again, what is the message here is that yes, 2 weeks ago, lots of rotation away from the winners that hit our performance temporarily. What we spoke to is that's a time you want to add money, be opportunistic. And if you did so, you're already up around 10%. So this is a good lesson, ladies and gentlemen, that pullbacks in your investments should be viewed positively if you have excess cash to put to work. So never, never, never get caught up in the short-term noise. That's what derails our long-term wealth building process. And we've seen that play out here over the last 2 weeks. First half of March, scary, a little bit of malaise in the second half of March, and then a recovery. And right when it feels the worst is right usually when it recovers, just like March of last year. So we talked about the inflation boogeyman. Now, Tim, when we think of our conversations over the last month to really the last 6 to 8 weeks, what would you say has been the number one concern as it relates to the market in general? Could be rates, inflation, could be the rotation. Like what are you hearing from clients and advisors?
Yeah, it's funny you asked that, because I actually just had a conversation yesterday about inflation, and kind of walks the advisor and the client through, what we've been talking about the past 6 to 8 weeks is structurally, we're just not seeing it, right? And I think that continues to be most likely because of media headlines, but a real concern on clients' minds.
Yeah, and we've been really consistent, ladies and gentlemen, because when we look at the raw data, unlike most investment managers out there, we actually look at the data. And when we look at the data, there is no what we call pipeline inflation that was coming down the chain. Now, there was some temporary, what we call transitory inflation. And we see that in the numbers here, ladies and gentlemen. Transitory inflation is just a fancy way of really saying temporary inflation. And how do we know it's temporary? Well, we know where the choke points have been in the economy. We know it's been the supply chain and the congestion at LA airport or LA ports. And what do we see here? One of the biggest contributors to inflation in the March report was transportation. And that was because of the bottlenecks that are taking place in LA and other ports across the US. That is temporary. That will clear up at some point, similar to if you think of the interstate around rush hour, it's going to get congested as everyone rushes home. Well, everyone's rushing to reopen. It's causing a bottleneck that eventually will normalize, and things will start to become a little bit more normal and functioning, and we'll see those price pressures come back in. The second thing was really being driven by energy and gasoline. And the Federal Reserve does not look at energy and gasoline when determining interest rate policy. Why? Because it's volatile, and it's also it's also tends to be temporary. So gas prices go up, they go down. And the reality is there's a lot of supply of oil right now. And so we're not really too concerned about those numbers. And the market saw that, breathed a sigh of relief. And the market, in particular, the stocks that we're invested in, did quite well, really getting bid throughout the day on Tuesday. So if we look at inflation, a picture says 1,000 words, ladies and gentlemen. This picture on the right here is inflation since 1985. We're at 10-year lows. So before we get all hot and bothered about so-called the inflation boogeyman making its return, well, we need to get back to where we even were last year. And we're not even back to where we were last year. So until we get to that point, that's not a conversation that we're having here internally as it relates to changing our asset allocation strategy. Until we see structural inflation being driven by sticky and rising wages, we're not going to let that impact how we structure and design portfolios, because it really, at the end of the day, that's what leads to structural underperformance.
And Rob, I think it's important whenever you're looking at data just in general, always put it in context. You know, when you see those headline numbers, they don't mean anything unless you compare it to it, right? Just like you were talking about, compare it to the 10 years, your decade lows in inflation. So whenever you're looking at data, try to contextualize it.
Absolutely. And you know, this, ladies and gentlemen, this is driven by the 24-hour news cycle. We need content if we're a news company and we're on the air 24 hours a day. And so when you see a sudden pop in inflation because the economy is reopening, we're no longer shut into our homes, we want to make a story out of it. And guess what? Fear sells. I know it's a common theme that we talk about every single week. Fear sells, but it's so important because it's the number one thing that really hurts our long-term returns. It's not stock picking. It's not market timing. It's investment behavior. And it's so easy to get caught up in the fear driven by media because they use these flashing red lights and people are losing their minds. Jim Cramer's having a heart attack on the air. And if we don't do this for a living, we're trusting them as the experts, right? They're on the air, they're on TV, and that can make us nervous, especially when it's our money and our savings. But rest assured, we're looking at the real data, the raw data, and we just don't see a whole lot of inflation there. In fact, gold has underperformed over the last 3 to 4 months. If we look at gold, has gone from close to $2,100 an ounce all the way down to about $1,700 an ounce. So not really indicative of what we call an inflationary environment. Despite what Bill O'Reilly and other people advertise to make sure you buy gold and all this other stuff, we pay attention to the data. We're still in a disinflationary long-term trend as it relates to technology and as it relates to population trends. And that it's going to take a lot of work to get out of that sticky disinflationary trend. Now, you might see, what's this crazy chart here that everyone's looking at? This is something that we look at a lot, ladies and gentlemen, is that we try to reduce what's called dispersion risk across our portfolios. One of the big mistakes I think a lot of people make is to say, well, a stock is overbought, so I'm going to sell that and I'm going to buy these stocks that are oversold, which is kind of what happened in March, by the way. The problem is that that's what we call home run investing. And if you look at throughout time, in baseball, a lot of home run hitters have pretty low batting averages. And I always bring up Mickey Tettleton. He was a home run hitter for the Tigers back when I was growing up, and he had like a 220 batting average, but he slugged out just an absolute enormous amount of home runs. The problem with that is you can get some stocks that do really, really well, but then you can get a lot of stocks that can devastate your portfolio. And so relative to the range of outcomes that we see here on this with these red dots, when you buy the most oversold parts of the market, you can have really good returns, but really, really bad returns. And so from a volatility adjusted basis, that risk adjusted return is just not that attractive versus what we see here when on the most overbought stocks. And as we were talking about as a team before we came out on the air, if you remember this, Tim, we don't just buy an overbought stock because it's overbought. We certainly don't do that. But what's interesting is that the most overbought stocks in the market tend to have a very positive skew. Notice how few dots are below this blue line, which indicates negative returns, and how tightly compacted they are in terms of the range of returns. In other words, they have what's called a high on base percentage, right? Again, kind of going back to baseball a little bit. What's the number one stat that we look at when we're assessing a hitter? Is on base percentage, not hits, not home runs. It's on base percentage. And we want to get on base. We want to hit a lot of singles and doubles, and we want to get our clients on base and generating those runs over time. And so for us, we want to focus on the healthy areas of the market, because the possibility of having devastatingly bad returns is just structurally reduced. Not impossible, but structurally reduced. And that gives us what we call an attractive volatility adjusted return profile, which is really what we look for, not over a 4-week time period, but over a 12 to 18 month and beyond time period.
Yeah, and Rob, one of the things we often talk about is when you're looking at those very oversold stocks, generally there's often a reason they're very oversold.
Absolutely.
If the fundamentals of the business are deteriorating, just because the stock went from 10 down to 5 doesn't mean it can't be cut in half again. So when you're playing on that end, it's really a question of return of capital, not return on capital.
That's such a great point, Tim. And ladies and gentlemen, to all our home gamers out there, it is one of the most important points that you can learn as an investor over time. The first hedge fund I worked at up in Toronto used to have just an incredible chart, and it was that of Enron. And it was as Enron was hitting 52-week highs and then started to break down and went from $300 a share to $200 a share, and analysts upgraded saying it was undervalued, and then it went to $150 a share, then $100 a share. It's very, very oversold. Then it went to $50 a share. And then finally at $20, $25 a share, the accounting fraud came out. And when stocks are making 52-week lows, someone knows something that's not in the tape, that is not out there in the public. It's what's called insider creep. And what that really means is that while insider trading is 1,000% illegal, information somehow gets out there, and you see it starting to be reflected in the stock price. You also see it on the upside, where you see these stocks that are breaking out on no news and no one knows anything, and it's not public. We don't see anything. And then suddenly we get good news a week or two later. And it's what's called insider creep. And we see that if you go through the CFA program, that's definitely a principle that is discussed, where a lot of times information leaks out and somehow it's getting out there, but it's not publicized in the headlines. And so we want to be very, very careful. The analogy I always like to use is that if you see a house that's on fire, do you go and put a bid on that house so that you can buy it because the price might be lower than it was the day before? Of course not. Wait to see if it survives or if it burns to the ground. And if a stock is making 52-week lows, especially in a market environment where the S&P 500, the NASDAQ, the Russell 2000, et cetera, are at 52-week highs, there's something wrong. And we need to identify what is wrong. And until we can see a catalyst for changing what's wrong towards that something that's right, in other words, a turnaround story, we need to be really careful. And it's actually one reason why we don't focus on turnaround stories, because turnarounds are hard. They're very hard, especially in a market dominated by big data and how companies can scale rapidly. Once you're behind, you're behind the 8 ball. And it's the percentage of companies that successfully turn around is very, very low. But we always hear about those successful turnaround stories. Just like on startups, we always hear about the successful startups, but we don't hear about the 99 other companies that failed in the process. So such an important point. I'm glad you brought that up, Tim. And it's something that we think about every single day when we come into the office. Here, ladies and gentlemen, just real quick, we talked about how when Wall Street is bearish, you need to be bullish. What we see here is the majority of Wall Street strategists right now are bearish. In other words, their price targets are below where the S&P 500 is. Now, to the layman investor or the investor that doesn't do this for a living, they would say that's got to be pretty bearish, right? I mean, everyone is generally optimistic on the economy and their price targets are below the S&P 500. That's not very good. What's interesting, ladies and gentlemen, is let's look at this. when the S&P 500 is trading above the consensus forecast on Wall Street, the forward returns are higher than when the S&P 500 is trading below consensus strategist forecast. Think about that for a second, and then think about what we just talked about with those stocks that are making 52-week lows. A lot of the times the market is sniffing something out that can't be played out in an Excel model, which is what strategists use, right? Whether it's a DCF model or whatever they're using, it can't quantitatively be explained. Multiples are expanding for a reason. Either interest rates are going to remain longer than expected, the recoveries is going faster than expected. There's something structural taking place that can't be modeled. And we got to pay attention to the price action, because the price action is similar to when we go to the doctor. The doctor doesn't say, hey, we're going to look for cancer today, or we're going to look for this illness or disease. They say, we're going to look at your symptoms. What are the symptoms that you are exhibiting? And then based on those symptoms, we'll do further testing. And that's how we look at the market. We look at the symptoms. What is the price action telling us and indicating to us about what might be taking place underneath the surface? Identifying the exact bullish or bearish cause or catalyst of the market is very hard. It's like finding the needle in the haystack. We look over the last 15 years, there's been no shortage of events that would seem bearish, but the market went up. We pay attention to the symptoms. And what we see here is that sales growth at 6.5% continues to accelerate. So top line sales expansion for the overall S&P 500, very, very hard to short the market in a tape like that. Now we are coming into May, a little bit of seasonal weakness there, but our stocks are a little bit separate from the S&P 500. So I think we're in pretty good shape there. And then speaking of symptoms, this is something that we like to look at. So UPS, FedEx, we don't own these stocks, but we do pay attention to them because they're bellwethers. UPS, FedEx, the rails, so you know, it could be Union Pacific, Norfolk Southern, CSX, Kansas City Southern, which recently got bought out by CN Rail. We look at sort of what we call the supply chain of the economy and those publicly traded stocks, and what are those stock prices doing? UPS and FedEx in particular, they're transporting retail goods, so kind of the backbone of transporting consumer goods. When they're making 52-week highs, that is not something historically we see ahead of recessions. These are usually the first stocks to break down. The market sniffs out, hey, economy is starting to weaken, sales are going down across the board. Sell these guys because they're massively levered to a healthy economy. So economically sensitive stocks that are breaking out to 52-week highs, not a sign that we're heading into a recession anytime soon. And then we look at risk appetite. We talked about this last week. The crypto space, we're huge fans of the crypto space. We think that it gets chastised as a space that people go to gamble. This is the real deal. We are in a period of massive innovation within the crypto space. To be very, very clear, we think that Ethereum long-term is probably it's going to be one of the most valuable software entities out there. It's basically, when you look at Ethereum, you look at it like a software company, but it's also an area that's very volatile. And volatility, when we know an asset has a lot of volatility, we also know that it will go down when risk appetite comes down. And so what we do is we pay attention to the crypto space, not just because we like the fundamentals of it. We like to look at how it's behaving. It can allow us to read the tea leaves of the symptoms of overall risk appetite as it relates to the broader stock market. We knew, looking at the crypto space, that in late February, early March, it started to bottom out a full 2 to 3 weeks ahead of the market and the NASDAQ. Then it broke out to new highs, and we saw those growth stocks start to break out as well. So what we've seen here is continued follow through buying. Again, we want to not pay attention to what happened today. There was a lot of volatility in the crypto space because of the Coinbase IPO. But generally speaking, these are very attractive charts. You coming out of a double bottom, cup and handle formation, breaking out to the upside for Bitcoin. And then the same thing happened in the Ethereum space. Huge cup and handle formation. And then not just a breakout, but follow through buying this week as well. So from a risk appetite standpoint, the fact that we're making 52-week highs in this space does indicate that the overall risk appetite environment is pretty healthy. And then Tim, do you want to go through this a little bit? I know we talked about this before, but really talking about how as that 10-year yield stalls, we're really seeing that secular growth leadership resume, and maybe how some of these reopen stocks are doing.
Yeah, so if we look at this chart on the right, what it shows is the US 10-year yield versus some of those cyclical stocks relative to the defensive stocks. In other words, we're talking about those reopening trades similar to the past few weeks. And what we're seeing is that US 10-year is starting to peter out. We saw, some rapid climb in the 10-year over the past few weeks, but it hit about 1.7, 1.78, and it's really starting to peter out. And you're also seeing those cyclicals peter out in turn. So that's kind of the action we're seeing on that side.
Yeah, Tim, and this, ladies and gentlemen, this is what we call our relative strength framework. So we like to not just look at absolute price action, but we like to see how certain assets are behaving relative to other assets. That can allow us to actually see how a certain asset class or stock or sector is sort of performing underneath the surface. So sometimes you can get where a sector or stock is actually hitting a 52-week high, but they might be the worst performing sector in the overall market, right? So in other words, the stock market's breaking out. It's breaking out just because the market is, but from an absolute price performance standpoint, it's the worst performing asset. And that can actually be what's called a weakening relative strength picture. So we pay attention to this stuff. And so when we look at the cyclicals relative to defensives, it's starting to break down a little bit, and we want to pay attention to it because we know that over the last week, we've had these giant, absolutely enormous cyclical inflows from retail investors. And not to disparage the retail investor, but typically those retail flows tend to be the last dollar to the party. So when we get these big retail flows into the cyclical sector ETFs, and we see that across the board, by the way, financials, energy, industrials, that consistent chase into that reopen trade, that tends to be the last gasp before these stocks start to come back in. And there's going to be some stocks within there that are the real deal, and we'll pick away at them. But generally speaking, when we look, if we go back a slide here, we look at the weakening relative strength picture. We see that the 10-year yield is running out of gas. We see that the NASDAQ is breaking out with strength to the upside on a cup and handle formation. The Russell 2000 is having a tough time making new highs. And then we look at the cyclical fund flows in from retail investors. That all sort of paints a picture, puts a puzzle together of a new sort of market leadership dynamic that's coming to the surface. In other words, a resumption of long-term secular growth leadership that might be starting to play out. We're paying attention to it. Stay tuned next week, the week after, to see if we do get follow through on that. But very interesting to note here, just as we're doing this framework, that Ethereum, which got hit a little bit today because of the Coinbase IPO, is right back to its highs. So this after the market close, but something again we always want to pay attention to. Don't get lost in the noise of very short-term events. We talked about this a little bit last week, but regime change again. That VIX is falling in below that prior 20 to 35 and 40 range, and going back to where we were prior to COVID, which is that 10 to 18 range. So we need to unleash that playbook from pre-COVID. We're going back to the pre-COVID rules. When VIX goes down, that means that demand for portfolio insurance or protection is also coming down. That's a positive symptom until you get to the bottom end of the range where no one wants any protection whatsoever. So then you want to go on the other side of the trade and buy protection. But right now, while a lot of people are saying, hey, VIX is at 52-week lows, fair point, but we're 52-week lows relative to a structural change to the upside related to COVID. we're actually at the high end of the range if we're in a pre-COVID environment. So that's the playbook we need to pull out and we need to pay attention to over the next few weeks and months. Last, but certainly not least, Tim, we always talk about the credit markets. It's the foundation of the stock market, of the bond market, of asset classes in general, including housing. And guess what? Over all this volatility over the last 5 to 6 weeks, not one peep of noise from the credit markets. This is why we've remained so consistent in our bullish belief, in our bullish framework, because there's just nothing coming from the credit markets to indicate that implied credit risk is ticking upward. So despite all that volatility, nothing, credit markets haven't blinked. This is very, very bullish. And then lastly, just reminders, ladies and gentlemen, stocks are always going to be swinging from a zone of being overbought to being oversold. We spend very little time trading at fair value. And so what we saw last month is we entered that zone of self-doubt, and now we're swinging back to the upside. Now, if we start to make 52-week highs, I want to advise all our clients and advisors, don't get too excited, because we will have other pullbacks later this year. And that's normal, that's okay, and that's healthy. That's part of long-term investing. So we're always swinging from a zone of overconfidence to a zone of self-doubt. But what is important is that the value line, the enterprise value line of companies, is consistently being built upward and to the right. And if you paid attention to that framework and used that framework, it would have allowed you over the last 15 years to own Apple, to own Amazon, to own Netflix and not trade it, and you would have actually built a huge amount of wealth. Now, we don't own those stocks right now outside of Netflix, but it's just an example of, we look at the leaders over the last 15 years, they've built tremendous amounts of value for the wealthiest people on the planet, but lots of people own those stocks and trade it at probably 50 or 60 times. Don't trade it, own it. That's how you build wealth. And that's really the message today. So overall, inflation appears overpriced. We got that data out of the way, thank God. And now we can refocus on long-term investing, focusing on the growth leaders that are leading the structural, secular growth areas of the overall economy, the leaders of tomorrow's economy, not focusing on the leaders of yesterday's economy. Overall, the credit markets remain healthy, risk appetite is healthy, and we want to stay focused on those areas of long-term secular growth. And last but certainly not least, those reopen or cyclical stocks, those boom bust stocks that really got a bid in March have started to break down. So pay attention to that stuff. I think we're well positioned here. For myself, I could tell you that our family continues to put money to work. We love it. We think the markets are well positioned, and we think the companies and the stocks and the sectors that we're focused on are going to lead over the next 6 to 8 months. We could be wrong. We can't guarantee that, of course, but all of our work suggests that. So just want to thank everyone for the patience over the last 6 to 8 weeks. Whenever you get a correction, whether it's in the market or whether it's just generally in the investment strategy you're in, it takes patience. And our clients and our advisors are just so incredible and patient. And that's what's allowed them to build value over the last 3 to 4 years, those 200% plus performance numbers. So thank you to everyone. Have a fantastic week. And if you have any questions or concerns, our advisors are here to help. And if you need to reach out to us directly, please feel free to do so, and have a fantastic week.